All right, did you know that there's 4 ways to profit off most home loans or investment loans for real estate? Okay, just to be clear, my name's Davin Sundvik with Sundvik Realty, and we're going over the 5 ways to make money in real estate. And specifically, today we're talking about the 5th one, which is loans. And in case you don't know the other 4, we've got passive income, price appreciation, tax advantages, and massive income opportunities as well. If you want to watch our previous videos, definitely check them out so that way you're in the clear and you know exactly what we're talking about when it comes to loans. All right, we save loans for last because you have to understand a lot of the other ways to make profit in real estate first before you can understand how loans work. So if you haven't watched those, I encourage you to do that now. But in case you don't want to or you think that you know everything, then let's get right into the topic. All right, we're going to break this into 2 parts. Part 1 is what we're talking about right now, which is going to be the passive part of profiting off loans. There's also an active component, a decision-making process or a strategy, right? And we'll cover that in part 2. It's not as complicated as you think. It's just really difficult to cover both topics in one video and make it short enough for you guys to be able to pay attention to, okay? So with that being said, let's jump right into the first few ways. All right. Today, we're going to talk about leverage, amortization, and inflation. Yes, you heard me right. You actually profit off inflation from having loans. Now, inflation hurts those who are cash savers and benefits those who are loan takers. What does that mean? Let's say you loan $100 from your friend to go buy a pair of Nikes, okay? Next week, the price of Nikes goes up to $200. And so what do you have? You have a $100 debt and you have a pair of Nikes, right? But if you didn't take on that debt, where would you be at? Well, you would still be without a pair of Nikes and it would cost you $200 in order to get a pair of Nikes. So essentially you bought them half off, right? Well, kind of. You borrowed somebody else's money in order to get the discount, right? And that's what we're talking about when it comes to inflation. It acts a lot of the same ways. So inflation lowers the price of your loan compared to the cost of other things, and it makes it feel much more affordable. It doesn't necessarily make it more affordable. It just feels more affordable in comparison to the price of other things. All right. With that being said, let's get on to amortization. Amortization is very difficult to calculate. We're not going to calculate it by hand in this video, but I will show you a calculator that shows the impact of amortization on your return on equity, which we'll talk about when it comes to leverage. So amortization is the small amount of payment that is made towards your actual equity. All right, it is an equity payment of your loan, and we will give you a visual demonstration on the whiteboard today to show you what that looks like as far as value is concerned. Lastly, we'll talk about leverage. Okay, once you understand a couple basic calculations, you can now see how leverage plays an impact in your total return on equity. Notice I didn't say return on investment. I said return on equity because real estate is a very interesting animal, okay? It is not dealt the same way as a stock is, for example. So because real estate is treated differently, we have to use different terms that more accurately represent the actual returns that you're receiving. Okay, with that being said, let's jump right into seeing how inflation works. Okay, we're at the whiteboard now, and I'm going to pull up my seat so that way we can go over how inflation works. So let's say we purchase a property, right? And it's worth $1 million, right? And so that $1 million property has a loan on it, and we purchased the loan, but we also have other expenses like taxes, insurance, and all these other things. Well, slowly over time, it'll just creep up because our taxes and insurance and all these other things are going to go up in price, but our loan isn't going to go up in price at all. That portion is going to stay fairly the same, right? Until it drops down and our loan falls off completely. And now our new set of expenses are much, much lower over time, and they will continue to grow very slowly, okay? Now, let's see the cost of renting the exact same property. Well, at first it might seem like it's a great deal. We don't have to put as much up front. We actually save money in the short run, but all of a sudden our expenses go up with inflation and it crosses that line at some point. It makes it much more expensive to be a renter compared to be a property owner. All right, so now we understand how inflation works, right? how loans work. We're going to tie this in at the very end to show you how it all ties together. All right, the next thing we got to understand is amortization. All right, so we'll start with a balance. Okay, on that $1 million property, let's say the loan balance is $800,000. It might start off really, really high, but then after 30 years, it's going to get paid off. And it's not going to get paid off in a straight line. You see, the bank keeps most of the money in there at the beginning, but then over time, it curves down and it eventually is worth $0, in which case you owe $0 to the bank and you can stop making your payments, right? In this time, we have been making the same monthly payment the entire time until the very last day when our payments drop off. And our payments are comprised of two numbers: the interest, which we do not get to keep, and amortization. So I'll draw another little curve here, right? So this is our interest. It goes down over time, and then our amortization is this little gap. This is our profit that we're paying to ourselves. And as you can see, every single month, this profit is getting bigger and bigger and bigger until the entire loan is paid off, right? And so this amortization in the beginning adds very little towards your return on investment, or return on equity, if you will. And at the end of your loan, it is actually a very significant portion of your return on equity. We're going to dive deeper in a later video on amortization, but you do need the basics just to even understand loans, okay? So you at least know what's going on there, right? All right, now let's talk about leverage. All right, this is where it's going to get fun. We're going to combine multiple pieces of real estate together now in order to be able to calculate leverage. In our cash flow series, we talked about NOI, net operating income, all right? And let's say that this is 6% of the property value. This can also be referred to as a cap rate, okay? Now, what if we also had inflation of 3%? So combined, we're going to assume that because the inflation index is tied to the real estate market fairly heavily, that real estate is going to go up with inflation. And so that this is a total return on investment of 9%. Okay. Now, yes, I did use the term return on investment, and that's because we're not financing this investment yet, right? Now, once we add financing to it, we have to divide by our interest rate. So let's say our interest rate is 7%. All right, so we got a 7% interest rate. So what we can say is 9% divided by 7%, this yields our return on capital, ROC. So every single dollar we invest, we borrow, we make $9 and we spend $7 to borrow each $100 worth of capital, right? So let's do the math on $1 million property here, right? So we got a $1 million property. So the value of the property, we're going to multiply times 9%. So we got $1 million times 0.09 minus our loan. Let's say we have a loan of $800,000, okay, times 0.07, all right? And we're going to divide that by the difference between $1 million and $800,000, which is $200,000. It's also known as your down payment. Okay, well, 1 million times 0.09 is 90,000. 90,000 minus 800,000 times 0.07 is 90,000 minus 56,000, which is 34K. And so we take 34K, we divide that by 200,000, and we get 17%. Okay? Now, what if I put all of it in? What if I included even my amortization and all the little details, right? My really, really fancy investment calculator that I made on my computer, and we actually get 17.7%. So your amortization in the very beginning is only worth 0.7% of your total return. But what you'll see is that towards the end, it might even grow to be even like 3% or maybe even 2%. So it changes over time, but just understand that your amortization is a major factor. And so, 17% to 17.7 and 17% might not seem like that big of a difference, but it does add up over time. But you can use this very simple equation and just forget amortization and use this as a conservative metric and say, okay, if I have amortization as a part of making profit, I will actually beat these numbers. And I'm actually using a very conservative estimate here for my ROE. So now you have it. Now you understand how to calculate inflation and how it's used to benefit you. Now you understand what amortization looks like and the very small percentage that it affects your return on investment. Even though it's small, it is mighty because it does lower your payment over time. And now you understand how leverage works. And this doesn't even take into consider the fact that you can refinance along the way and maybe even improve on your returns over time. With that being said, let's jump right into part 2. And so that way you can understand when it's time to refinance and when it's time to avoid it.